Again, my name's Steve McKnight. It's a pleasure to be with you tonight. We're going to be talking about what's happening in the property market at the moment, and I'm going to try and do the impossible. I'm going to try and fill your heads with so much information that by the end of tonight, you'll be walking out feeling confident and equipped. You'll have some idea of where are the best markets right now to be investing and which ones to be avoiding. And more so, when it comes time to selling real estate, you'll feel like you're smarter than the real estate agent you'll be using to sell it. So I'll leave you with some practical tips there. Tonight's update is a little intro, which I'll do in a second, then the market update, area spotting, and a deal that I came across walking back from my daughter's fair on Saturday last. I'm gutted, and you'll find out why tonight. We'll talk about the art of selling property, the looming great property boom ahead. If there's more time, I'm happy to do Q&A again at the end, but we're probably going to be struggling because I've got about 2.5 hours worth of info that I want to make sure that we cover in 2 hours. Please make lots of notes. I won't be giving you a copy of the slides tonight, so it will be up to you. If you have a smartphone and a smart user, then by all means pull it out, take photos of the screens, do whatever you've got to do to capture what you need to capture. I don't even care if you want to record it. I recommend you don't because I'm giving you a free copy of it anyway. That's what Daz is here to do at the back of the room. But do whatever you need to do to empower yourself to gain the knowledge that you need to get. My objectives, really quickly, there are 3 of them. To reconnect you with your investment objectives. All too often we have these fancy pants reasons why we want to invest. Life gets in the way and we drift off. I want to bring you back to the core reason you're interested in investing in the first place. I want to help you to see the opportunity that's knocking down your door. Everyone say knocking. Say it like it's knocking. There's something knocking down your door right now, but you might just be in the bathroom and too busy to go and bother opening the door. So I want to help you to connect with this knocking opportunity. And as always, I want to try and help you make more money out of your property investing. Introduction. This is really, really important. All right, I want you to count. I'm about to show you a video which will go for about a minute. I want you to count the number of times players in white, what colour? White, pass the basketball. All right, it might be a bounce pass, it might be a chest pass, but you need to concentrate. And even more importantly, you need to keep absolutely quiet. So on the count of 3, we're going to practice being quiet. 1, 2, 3. All right, that's what I want to hear the whole time throughout this video.
This is a test of selective attention. Count how many times the players wearing white pass the basketball. How many passes did you count?
All right, let's see. What do people think? All right, hang on a sec. So starting with, who counted to start off with? Who actually participated? All right, very good. Because some people are like, nah, too hard, end of the day, whatever. They weren't even present for the learning opportunity. But let's have a think over here. Anyone, well, let's go. What? 16. Anyone less than 16? All right, 15. Anyone less than 15? 14. We're going down by ones. This is encouraging. 14. Anyone less than 14? Anyone less than 13? We'll go the other way in a second, but anyone less than 13? 12? Anyone less than 12? All right. No, or if you're less than 12, you're not going to own up now, so fair enough. All right, anyone more than 16? 17? 25? We've got a 19, we've got a 20. Now, all right, that'll do. I think we've got enough things up here on the board to prove the point. Were we all watching the same video? Yeah, there wasn't a different video on that side as there was on that side. We're all watching the same video. So how can we have such a large disparity on the number of passes? Well, it's got to do with ability, let's be honest, right? Some of us are better at counting than others. And it's like that in the property market as well. There's a right answer, and then there are people who are under it, and then there are people who are over it. But, you ready? But did you see the gorilla? All right, so roughly half of you won't have seen the gorilla that came in the middle of the video and went like this and walked off. And the half of you that did see it probably thought, what the heck's a gorilla doing walking through the middle of the video? Which is why it was really important to be quiet, so you didn't alert other people. In your day-to-day life right now, what's consuming your focus? What are the passes that you're counting? Because while you're counting these passes, while you're busy going through life day to day, how is this counting the passes stopping you from seeing the gorilla opportunity that's right there? People say, oh, I didn't see the car. I didn't see the cyclist. It just came out of nowhere. You've heard that, right? Well, that's this. This is selective attention. Now, this was done as some kind of psychological major, an actual psychological experiment to prove that people can't see the obvious when they're not looking for it. And my application is to say, well, right now there are amazing things going on in the property market, but we're so focused on what we need to do to get through the day that we never even get to see this exciting opportunity that's in our midst. And why not? People are too busy. It's the wrong time. They don't know how. They don't have money. They're too old. They're too young, too fat, too skinny, too smart, too dumb, too educated, not educated enough. All forms of the spectrum, people convince themselves that they can't do it. And so they don't do it. They don't try. Conclusion. What great deals are passing you by because you're too busy not looking for them? I'll say that one more time. What great deals are you missing out on because you're too busy not looking for them? When I got started with my wealth creation, there weren't events like this to go to. There weren't books like there are around today. Most of the books were written by US authors, or they were on negative gearing. So I went, and if you haven't read his material, Robert Allen is a fantastic author. And the book I was reading back in the late 1990s was a book called Creating Wealth. And in that book, there was this story, which I'm about to relay to you right now, about how they catch monkeys in the forests of Indonesia. And if you heard me say this again, then if you've heard me say this before, then just bear with me for a second. They're only little monkeys, right? They're not big gorillas. And what they do is they put bottles in the forest, and then they put peanuts in the bottle. And the little monkeys come along, and what do they want? Everyone say peanuts. They want the peanuts. So they see the peanuts there and they put the little arms in and they grab hold of the peanuts, and their arms are skinny enough to reach in, but once they've grabbed the peanuts, they can't pull it back out of the neck of the bottle because the neck of the bottle is only so big. But they want the peanuts, but they want to get away, but they want the peanuts. So they don't know what to do and they sit there arguing with the bottle. So they get angry, and you see this in road rage all the time, right? People get angry at the steering wheel or "Urgh." And what happens is people come along with Hessian sacks, throw them over the monkeys, cart them off to the market and sell them as pets. The question I've got for you, again, to help you to realign back to your investment objectives, what you thought was important once upon a time to be interested in investing in the first place, is what peanuts are you holding on to? What are these things that are ultimately holding you back, and how do you let go of these peanuts so that you can escape? I'll give you an example of two peanuts. One is, I'm too busy in my job to invest. And the other one is, I'm so maxed out with the properties that I own, I can't afford to buy any more. They're the two common ones that I get. But you can't move on until you let go of the peanuts. What's holding you back right now? Nominate, write it down, the number one thing that's holding you back from allocating the effort that you think you need to give to your investing, but you're not. What's one thing, the biggest thing that's stopping you? Write it down. Don't think about it, write it down. Take action. All right, does anyone want to volunteer an answer? Thank you. Fear of failure. Anyone else have fear of failure? All right, you're not alone. Well done. Can I have another one? Money. Don't have enough money? Does anyone else have money down? All right, good. Anyone else? I have time for two more. Yep. Lack of time. Anyone else have time down as their number one issue? And one more. Someone's going to have knowledge, don't know how. All right, anyone else would get it to it, but they don't know how. All right, so these are the common issues that we all have to face. You're not special. You're not different. These are the issues that I had to try and overcome when I got started. I had to get the time to invest, so I had to give up my career as an accountant. I had to get the money to invest, so I had to live off my wife's salary so that we could invest all the money that we made in the accounting practice. I didn't know what I was doing. I had to make it up as I went along. Fear of failure, not enough knowledge. Again, there weren't seminars like this to go to. And so you're either letting these things stop you or you're finding out solutions and moving on. We're going to have a break for a minute. I want you to find a buddy, someone who you can confide in. And I want you to talk openly amongst yourselves about what it is that is holding you back from moving on. I'll give you 1 minute. Go. Last thing I'll say, and then we move on. There are three aspects to your life. I'll give you the last one, or the first one, depending on which way you want to look at it. It's your past, which means we also have the present, good, and we have the future. All right, bit of NLP here, make sure we're all engaged. We have do we all have a past? We have do we all have a present? And we have do we all have a future? No. Well, we may have a future in the sense of we might go a little bit longer, but maybe we don't have the future that we want. People who live in the past are called what? Dreamers. Or people who live on memories and that kind of thing. People who live in the future are also called dreamers. But here's the point. People let their past dictate their present and their present dictate their future. This is going to be really powerful. If you keep the status quo of what you're doing right now, will that deliver the future that you want? If the answer is yes, well done, keep going on that path. But I'm anticipating most people, I'm going to ask this question again, and I want you to engage because this is important for you. Will what you're doing now lead you to the future that you want? Yes or no? All right, if the answer is no, does it make sense to keep doing what you're doing here? No. So what must you accept has to happen? Change. And because this isn't going to realise this. And we'll finish up with tonight the 4 things that you must do to transition out of this into a better this. And it frustrates me that people skirt around with this all the time. The older you get, the harder it is to change. So you don't want to muck around. All right, market update. What's the property market doing right now? Given a choice, do you agree that most people would rather own than rent? Yep. And there are 4 things, in my opinion, that need to be present in order for people to make that transition out of renting and into ownership. And the theory here is that if people could own than rent, then more people moving out of the rental pool into the owner market is going to do what to property prices? So you're going to have to think tonight. And you're going to have to participate. This is for you, not for me. If people move out of renting into owning, there is more demand. More demand, same amount of supply should put prices. Good, thank you. So given a choice, most people would rather own than rent if, number one, they felt they could afford to. Point number two, they could access finance. Point number three, they have a secure outlook about their future. And point number four, they can find a house they like at a price they're happy to pay. If we get ticks next to those 4 points, we can project that the property market will be going up. And if we want to take the pulse of the property market, yes, we can look at the 5 indicators we're about to look at, or anecdotally, we can come back to this question and say, how's this looking? The 5 technical measures that I monitor to gauge where the property market's going are median house prices, jobs and employment, housing finance, housing approvals and sentiment. Prices, jobs, housing finance, housing approvals and consumer and business sentiment. And we're going to go through each one of those. So if you didn't get those 5, you'll get them in a second. The first one is median house prices. And I've got a little race for you. And I've got 4 horses in the race. I've got Perth and Sydney, Melbourne and Brisbane. And who do you think's going to win the race? Hands up if you think Perth's going to win the race. All right. Hands up if you think Sydney's going to be the best performing market year on year. Hands up if you think Melbourne's going to take the cake. Or Brizzy. All right. On your marks, get set. Together, on your marks, get set. All right, and they're off. And Brisbane went backwards the most. So all the horses went the wrong way in the race. What's going on? Brisbane, minus 7.5. Then Perth, Melbourne, 5.4. Perth, 4.6. And Sydney, 2.7. If we looked solely on the year-on-year prices, what would we conclude about the property market? Good time to invest, bad time to invest? Bad time to invest. Prices are going down. Most people are growth investors. If we then stop and we look at year-on-year change in dwelling values, Hobart was the worst performing, then Brizzy, Melbourne, Darwin, Perth, Adelaide, Sydney. Only Canberra went up. And then we have the combined cities and the combined RDS. What I want you to see is there was only one market over the last year that went up, and that was Canberra by an insignificant amount. Everywhere else went down. All right, so that was the year. If we looked at the year, we'd say, I'm not confident about investing in real estate. Let's do the same thing for the quarter. Same 4 horses. Which horse is going to win? On your marks, get set. Together, on your marks, get set. And they're off. And now, well, Perth and Melbourne are heading the right way, but Sydney and Brisbane went the wrong way. But it's nowhere near as dramatic. If we just simply looked at quarter-on-quarter price movement, would we be more confident or less confident about investing? More confident. And then if we did the same thing for the month, same 4 horses. On your marks, get set. Go. And they're off. Go, you good thing, Melbourne. Melbourne wins 1.8%. Perth still minus, Brizzy flat, Sydney up a bit. Looking at month on month, we would probably conclude, wow, Melbourne might not be such a bad place to invest. What's the application? The application is, even though we're all watching the same video as to what's playing out in the property market, we're all focusing on different things, which leads us to have different outlooks and opinions on what's likely to happen. So you might have buyers and sellers in the one market. Looking at median dwelling prices, generally, Melbourne, as we've seen in the stats, up 1.8%, 0.3, minus 5.4 for the year. Returns, negative return. Amazing. If you buy property at the moment in Melbourne, there is no income return. Median dwelling price, 465,000, which is the first, second, third most expensive dwelling to buy in the country. Canberra is more expensive than Sydney. Why? Well, what I've done is I've used data from the Australian Bureau of Statistics, and I've taken the median income that someone in that state earns, and I've divided it into the median house price. So income in Victoria, 75,348, 465,000 divided by 75,3.8 gives us, it takes 6.17 years of full-time income to pay off your home. Now that doesn't really mean much, but we can look at affordability against other states. And so Melbourne is the second least affordable. Well, Victoria is the second least affordable out of all those up there on the slide. But at least it's improving. It went from 6.58 to 6.17. One of the 4 points about whether the property market's going to go up or go down is that property is more affordable. This slide says that we are getting more affordable, but compared to, say, WA, where the incomes are really high because of mining, or Canberra, where the incomes are really high because they're all public servants, we're still quite unaffordable, relatively. We're talking about dwellings. Now let's talk about houses. Again, Melbourne house prices, median 500, month on month up 1.8, quarter 0.3, year on year down 5.4. Third, Canberra's the most expensive, Sydney and then Melbourne. Now, people get all confused about data. It doesn't necessarily mean anything. So what we need to do is look at the data to try and understand trend. And the way that I do this at each of the market updates, and if you've been to market updates before, you'll be familiar with the look of this particular slide. So from the Real Estate Institute of Australia, way back to 1980, I've charted median house prices. And then I try and look for trends. And for instance, looking at these lines, where the property market is today, it's about where it was at the start of 2010. So except for a little glitch last year, if you had bought property any time in the last 2 years and it was indicative of the median house price, you're now sitting on negative equity. The value of your house has gone down relative to what you bought it for. Why? Because the property market adjusted down. What I like to do, though, is to try and identify a trend with the view that price behaviour, historical price behaviour, is some kind of indicative guide as to what might happen in the future. And by showing you this, what I'm hoping you'll see is that there is a trend in the property market and an upper limit and a lower limit in that trend. Generally speaking, looking at the shape of that diagram, I haven't drawn this very well, the property market goes up and down. If we took a line of best fit long term, we'd say that the property market trends up. Change colours for you visual people. When the property market is above the line or below the line, what do we call that? Close, starts with V. Volatility. All right. So when it's above the line, volatility means sensitivity to price change. Do we have extra volatility that prices will go up or go down? Who says up? Who says down? Who's not saying anything? Property market. As it goes up and up and up beyond its long-term trend, the volatility, the most volatility is which way? Back down again. And as the property market goes down below the line, volatility starts to increase so that we have volatility that prices are going to go back up. Exactly. So this is our property market, and volatility is the lesson about snapping back into shape. And you thought it was an elastic band. If we look at the Melbourne market, and we said the Melbourne market, that was the trend over time, and we concentrate on the right-hand side, as you look at it, it went above the trend, didn't it? And then what happened? It snapped back to the trend. And it's interesting, if that trend is accurate, that there was one little point where it went below the trend, and what did it do? snap back up to the trend. Right, visual. I want you to imagine the property market like an elastic band. It's always stretching one way or another. 2 years ago at these market updates, I started talking about investing in the United States of America. And what was the opportunity that I saw at that time? Well, housing market theory, line of best fit, except in the US, what happened to prices? All right, if this is our trend, prices went down. And so Steve McKnight's theory about real estate investing meant that there was increased, starts with V, volatility, that prices would snap back up again to their trend. Now, it's early days, but prices in the market where I was buying in Fort Myers, or are buying in Fort Myers, have gone up between 30 and 50% now. But they fell by a substantial amount. So this might have been 120 grand, and the stuff that I was buying fell to 20 grand. And see, now it's back up to sort of maybe 40 or 30 grand. So percentages are a little bit misleading. With that in mind, what do you say about the relative worth, generally speaking, of Melbourne real estate? Is it overvalued? No, overvalued would be above. Is it undervalued? It's roughly, starts with F. Andrew, yell it out. It's fairly valued, but is it fairly valued on the upside, fairly valued on the downside, or fairly valued on the fair side? Okay, this is important. It's fairly valued on the upside. Good. And because it's fairly valued on the upside, what do we think about if all we looked at was this, the possibility of prices jumping up as volatility snaps back? Yeah, it's possible, but it's unlikely. Now, bear that in mind, and let's get in our TARDIS, and let's go to all the property markets in Australia. And we're trying to buy what I call dumb growth. Dumb growth is buying something and just forgetting about it and waiting for the market to cause it to go up in value. For those of you doing the property apprenticeship, it's called generic growth. Right? I'll call it dumb growth for the purposes of tonight. So that's Melbourne. If Melbourne was the only market we could invest in, would you be worried that properties were wildly overvalued? No. Just quickly, because now you've seen it, what I chart here is quarter-on-quarter growth. And in particular, looking at what's just happened recently, we see quite a lot of volatility where prices are now trending down quarter-on-quarter growth. So the recent optimism that we've seen in the market, which is what's caused Melbourne house prices to go up, is contracting. The trend is against Melbourne house prices continuing to rise. That's the application for that slide. But all right, so that was Melbourne. Let's move on to Sydney. What do we say? Overvalued, undervalued, fairly valued? All right, fairly valued. It's in the trend. Is it fairly valued on the upside, fairly valued on the downside, or fairly valued on the fair side? I'll see if I can read. Lee, what do you say? Fairly valued, overvalued, undervalued? All right, good. I'll give you a hint. If it's between the lines, it's fairly valued. So you say it's fairly valued. Is it fairly valued on the upside, the downside, or the middle side, do you think? Okay, good. Well done. You've made a call. That's important. Congratulations. Give Lee a round of applause. Encourage the guy. Wasn't that scary? Because you might have been wrong. And then you might have had a couple of hundred people sort of think, hey, this guy's looking at something I'm not. But better to be wrong in the room here than out there in the marketplace. We're all friends here. So would we be investing in the Sydney market for dumb growth at the moment? No! What about the Brizzy market? Oh, now the penny drops, doesn't it? What about the Adelaide market? What about the Perth market? Well, it's at the bottom of its trend, so there's volatility that might snap back up to the top of the trend like it did here, and you might make $100,000 in the course of a year and a half, because that's the distance between the trend. All right, so if you could invest in any of these markets, Melbourne or Sydney or Brisbane or Adelaide or Perth, for dumb growth, which market would you be investing in right now? Write it down. No, don't yell it out, write it down. Who's investing in Melbourne? All right. Who's investing in Sydney? All right. Who's investing in Brisbane? Who's investing in Adelaide? And who's investing in Perth? All right. Who's investing in a city not Melbourne or Sydney? Hands up. Now, coming into the room, would you have said that? So in the course of roughly half an hour, I've been able to show you how, using some really common sense information, you can gain an understanding of what's happening in the property market and where the best opportunities are on the basis of volatility, sensitivity to price change. What's the application? The application is, when we invest, there are two things we need to weigh up. The upside of being right versus the downside of being wrong. And if the upside of being right is greater than the downside of being wrong, we go ahead and invest. If the if the chance of being wrong is greater than the chance of being right, we don't invest. So let's come back to Melbourne for a second. What is the upside of being right? Large or small? And what is the downside of being wrong? So there is a comparative greater downside of being wrong than upside of being right. So we wouldn't jump in the Melbourne market right now for dumb growth because it might fall further. We can always jump in a year's time or 18 months' time and not take the risk that prices may go down. But if we're property investors, and in this case growth-focused property investors, we want to try and pick a market where the risk of going down, which exists, there's always risk that things will go down, but we want to make sure that's smaller than the risk of things going back up. On the balance of probabilities, as I look at that graph, I would say there are better generic or dumb growth opportunities than the Melbourne market right now. If you still want to invest in Melbourne for growth, that's fine, but I would hold off. I'd hold off until we saw what happened with that trend line over the next few quarters. In my opinion, there's too much risk of jumping in relative to prices slipping down. All right, let's look at jobs. Now, we hear in the papers every day, particularly here in Melbourne, about the number of factories that are closing down and job losses. But Australia-wide, if we look at the graphs rather than the numbers just for a second, there are about as many people gaining jobs as there are people losing jobs, and so employment and unemployment are roughly steady. Why is employment an important driver to potential property price movement? Well, if people have jobs, they can borrow money. People move to towns because of jobs, or they move away from towns if their jobs dry up. Let's look at Victoria in particular. All right, second largest labour market in Australia. I'll say that again. Second largest labour market in Australia. Is that a generally good thing or bad thing for property prices? Yeah, generally good because there's a large employment base. Unemployment 5.4%, up from 5.2%. If unemployment was to go up and everything else was equal, what would we think would happen to housing prices? They go down. Yep, because people lose their jobs, they might have to sell their house, or they move away to another area and rent or buy in that area. Participation rate is about equal. So there's no influx of people looking who have got jobs or not. That's steady. This graph is insightful because what I've done here for you is charted the Melbourne median house price courtesy of the REIA, since 1980 on the left axis, and on the right axis, I've charted the unemployment rate for Victoria, according to the Australian Bureau of Statistics. And what we see is when unemployment went up coming into the recession of the early 1990s, property prices were stagnant until the unemployment rate started to go down. And then when it hit a certain point, it correlated with housing prices going up dramatically. Then, as unemployment ratcheted up, house prices starts with down. And then when unemployment started to go down again, house prices went. And we say that there is an inverse relationship between unemployment and house prices. And this, so that the graphs can line up, was as at the December 2011 quarter. But I have unemployment information for January and February, but I don't have housing information. And I'll put that up there now. So unemployment was 5.1 in December 2011. It's now 5.4. So unemployment has gone. And we would expect, therefore, that house prices will go. And so would we jump in and buy property right now? No, because there's another bit of the jigsaw puzzle now that's telling us, hold off, because the risk of being wrong is starting to look bigger than the risk of being right. What's the conclusion? The conclusion is that there's a time period between employment and house prices. It's not immediate. But unemployment is starting to tick up a little bit in Victoria, and we're hearing that about people losing their jobs out of the manufacturing skill base in particular. And it's not easy being a 40 or a 50-year-old losing your job in Toyota and having to reskill and go somewhere else. And according to me, to make a bold prediction, because of this unemployment ticking up, price history is likely to be flat or declining for the remainder of 2012. Now, do you want me to tell you something that makes you feel better, or do you want me to try and tell you the truth? Yeah, I mean, you guys don't come to these meetings to hear me, blow wind up your backsides and send you off into the world. I'd rather you leave equipped with some kind of knowledge to make accurate decisions than leading you into something at buy at all cost and you end up losing money. In case you haven't got it, if you're looking at buying in the property market right now for growth, don't. Hold off. That's dumb growth. We look at housing finance next, and in particular, I want to draw your attention to investment housing for fixed loans falling by 7.1%, purchase of new dwellings falling by 6%. The finance market is dominated by owner-occupied housing. And so coming back to this slide for a second, although the biggest movement has been in investment housing, if there's relatively not much movement in owner-occupied housing, then we can be artificially misled by those statistics. And going to the Australian Bureau of Statistics commentary, the total value of investment housings rose in January 2012 compared with December 2011. A rise was recorded in communities for the purchase of dwellings by individuals for rent. Individuals. But falls were recorded for the purchase of dwellings by others, government, and also the construction of dwellings. So we have loans taken out for individuals staying reasonably okay, but investment loans and construction loans falling, dragging down overall housing finance. Again, I like graphs because they help us to identify trends. So we've got this graph on the screen right here, and this is housing finance commitments in Victoria by number. And we can see way back to January 2002 on this one, and we're charting what has happened with the movement in housing finance commitments. And where we are at the moment is still quite high compared to the last 10 years, but we are trending down. Why is this important? as less people seek to borrow money, it's indicative of more or less demand. Less demand. Is less demand generally a good thing for the property market? No, it's another piece in the jigsaw that tells us to do what? Hold off. Look at the headline. I'll read it to you. Home or bust. Default fears as Australian banks return to high-risk loans. If that's all you knew, would you say that was going to be a good article or bad article? Bad. But let's get into the text. It says, despite warnings from the Reserve Bank of Australia and investment experts, nearly 70% of lenders are writing home loans with deposits as low as 5% of the value of the property. This compares to just 50% of lenders 2 years ago. Whoa, hold the phone. Do you think that more lenders writing more competitive loans is a good thing or a bad thing for the property market? It's a good thing. Because more people can access finance, they can buy houses. That makes affordability better. Conclusion. Look, investing finance is flat for owner-occupiers, down for others. There hasn't been any significant impact on the property market of the interest rate movements of late last year. So if the idea of dropping interest rates was to stimulate the property market, we haven't seen any meaningful impact of that. Rates would have to drop more in order to have the effect. And then lastly, lending's becoming more competitive, which is a good thing. Two more things to look at, then we'll wrap up the market update. Next one is building approvals. Don't worry about the numbers, look at the graph. Do you think building approvals are going up or down? Do you think building approvals going down is a good thing or a bad thing? It's a good thing. Why is it a good thing? Okay, housing approvals doesn't speak into demand, it speaks into supply. So if we're building less homes, again, I like graphs, so I've charted monthly dwelling approvals for Victoria, and we can see that it's trending down off an extraordinarily high base 2 years ago. Where we are at the moment, though, there's only been maybe 10 years out of the past 30 years where we've built less homes or less housing starts. So there's been a dramatic correction. Conclusion, the market is naturally correcting after a recent building boom. If the developers can't get the pre-sales, they won't build, they won't be able to get finance, and so the number of new home starts drops. There's a building lag, which means the next cycle is probably going to be 12 to 24 months away. And you'll see this in a second when we look at the supply stats. Right now, stock January 2012, there is 37.79% more houses for sale in Victoria than there was the same time last year. Look at how many houses are for sale. Almost twice the number there are in Sydney. The discount that people are willing to take for the sake of selling has gone from 6.1% to 7.4%. And worryingly, the vacancy rate in Melbourne is almost double everywhere else. That tends to indicate that there's a what kind of problem in the Melbourne market right now? There's an oversupply. And if there's an oversupply, is that a good thing or a bad thing looking for the immediate future of the housing market? It's bad. Supply's up, discounting's up. We've got the highest vacancy rate in Australia. It's not good news. Here, take a photo of that one if you want to get it. Consumer sentiment. Last one we're going to look at, or sentiment in general, look at consumer sentiment. Just go to the very last paragraph. Bill Evans, Westpac chief economist, said the fall, because mortgage hikes hit consumer confidence, the fall meant pessimism now outweighed optimism among consumers. Consumer spending, consumer sentiment feeds into spending. If we look at business sentiment, I'm confused by the headline here. Business confidence down. And then we come to here, business conditions improved slightly. That's why you don't just read the headlines. But as businesses become more confident, they put people on. As businesses become less confident and people leave, they make do. As of today, I saw this article come up in The Australian, March 29. One of the biggest falls in household wealth on record is undermining confidence and contributing to Labor's difficulty persuading voters of its economic credentials. Reserve Bank estimates show the average household's net worth fell 6.5% last year and is just more than 600,000, and at just more than 600,000 is now 11.5% below the 2007 peak. The bank's latest view of the stability of the financial system says the fall in wealth is contributing to a radical change in savings behaviour as households pay off debts, sell shares and put more money in bank deposits. Is that a good thing for the property market? Not right now, but it is in the future because why? They're going to have cash and they're paying off debt so that they can re-borrow it again in the future. What's the conclusion? At the moment, people are risk adverse, they're insecure, they're conservative and they're pessimistic. We started off the market update saying, given a choice, most people would rather own than rent if they felt they could afford to. Is affordability getting better? Yes, so we can put a tick next to that one. If they can get access to finance. If they have a secure outlook. No. If they can find a house they like, well, there's a massive oversupply, so you would have thought so, at a price they're willing to pay. There is one massive of those four things missing, and that's this secure outlook. Property in Melbourne is at the top of the trend range. And so once again, the upside of being right and you're going to get growth, in my opinion, is not worth the downside of being wrong. And so there are better dumb growth opportunities elsewhere. All right, looking at the body language of you guys here tonight, it's like, oh man, this is a bad time to be investing. Oh, why did I come out tonight? I could have stayed home, or I could have done something else. I didn't need to pay to come in here. It's a bad time to invest. Steve could have just sent me an email, don't invest. Yeah, but what I want to try and leave you with is not just how things are happening at the moment, but the tools to be able to spot as things change and then the rebound, the volatility snaps back up again. What are the 5 things we need to monitor? The first one is median house prices. The second one is, the third one is, fourth one is housing approvals, and the fifth one is sentiment. And I've also tried to help you identify what are the better markets to be investing in, because if you want to invest, you don't just have to invest in Melbourne. Some of you who came to the last market update, all right, you guys would have remembered me talking about the fund that I'm setting up. Just want to give you a little update. We have an ASIC license for the responsible entity, and we have a scheme registered to get going. The last thing I need is a product disclosure statement, which I'm working on at the moment. For those of you who don't know what I'm doing, I'm putting together a passive income fund. And the idea of the fund is to go and pool our money, go and raise $50 million and go and buy commercial property in the United States of America. And the strategy is the commercial property in America will deliver an income return. It will deliver capital gains as values go back to where they should be on their long-term averages. And as the dollar normalises, if it does normalise, back to its long-term average, then there'll be a third way of making money in the fund. What I like about this as well is I'm going to treat it as a source of education for those who are interested and want to be a part of it. And that is twice a year, once in Sydney, once in Melbourne, I'll run a one-day seminar, which people who invest in this can attend at no cost, to see the deals we're looking at buying from the inside out rather than the outside in to gain an idea of what's going on. So it combines my two passions, making money and getting educated. It's not something that you buy. I need to send you the product disclosure statement when it's ready. I'm trying to have it ready in time for conference. So if you'd like to receive the product disclosure statement, we've got about 30 million of the 50 million pledged at the moment. If you'd like to receive a product disclosure statement, put your hand up and I'll give you, or the team will give you one of these cards. Fill it in and just hand it back before the end of tonight. The next thing I want to talk to you about is area spotting and this deal that I had in progress. All right. When I did this market update in Adelaide, I was lucky enough to have a friend of mine, Marty Ailes, come and do a half-hour segment. Now, Marty lives in South Australia, so I couldn't get him here tonight. But I'm going to channel the spirit of Marty Ailes by sharing with you some of Marty Ailes' theory. And I'm applying it to the Melbourne market. If we took a map of Melbourne, straight off Google Maps, and put it into grids like that, or into quadrants, and we had 4 quadrants, north, south, west and east, where do you think is the best quadrant to be investing? All right, north, who says north? All right, south, who says south? West, who says west? And east, who says east? All right, we have a difference between west and east. What do we have over here? We have some mountains called Dandenong. So we have a limit of how much available land there is out east. Is there any such limit out west? No, so it can keep going out and out and out. And indeed, we've got Caroline Springs, and then we've got Melton, and we've got paddocks that will one day all be houses. All right, so with that in mind, are you better off west or east, generally speaking? East, simply because there's less supply. They're not making any more houses, any more land out east. Now, are you better off north or south? South, because again, what's this? There's a limited amount of land here versus an unlimited amount of land north. You can keep going further and further out. So if we could only invest in one quadrant, what quadrant would it be? South, because people would like to live by the water if they could. So the best quadrant to be investing in, if you had a choice out of the 4, is south. But what we can also do is draw a little circle around what's regarded as inner city suburbs. So the inner west, the inner north, the inner east, and the inner south. And now, if you could invest in any one of those quadrants, which quadrant would you invest in? Who's north? Who's east? Who's south? Who's west? What I did is I printed out Melbourne's rail transport map, and I identified a 1.5 kilometre radius around stations. Now, my logic is there's going to be more or less cars on the road in Melbourne as years go on. More. And so people are going to want to do what? Catch the train. So, and then what I did is I looked for properties that were 85% of the median house price for that area. And my strategy was to buy on long settlements and look to add value. And so when I printed out the rail map, and I looked and I looked and I looked and I thought, well, you know, the east is largely unaffordable. If I was trying to get in at around the median house price for Melbourne, I'd have to stick inner west. And in Melbourne, if I go back to the map, we've got the Western Ring Road, right? It's this little puppy that comes around here. What I wanted to try and do is make sure that I'm on the city side of the Western Ring Road. Because to me, if it's not already, the Western Ring Road will become the divider between inner west and outer west. And so going forward, being on the inner west side of it, to me is a smarter bet. Now, I'd love to be out east, but out east, the same distance from town, is going to be 2 to 3 times the price. So I'd rather own 2 inner west properties than 1 inner east property to diversify, spread my risk, etc. So I picked Seddon as my station. You could pick any station at all. I just picked Seddon. And then I went to Home Price Guide and I looked at the median house price for Seddon, which is $617,000, and I wanted to buy at less than 85%. And so my purchase price was $523,925. What's the logic for buying at less than 85% of median house price? You guys haven't seen this tonight, I'm sure. If that's median house prices on the long-term trend, I'm trying to buy down here with the belief that if I can fix the problem for why this property is down here, it will snap back to median. It also allows me to limit my loss, because if I make a massive mistake, then putting it straight back on the market means I'll only lose costs on the way in and costs on the way out. So there's some risk mitigation there. So I went to realestate.com.au next and I went houses for sale for less than $525,000. And I could have said 550 and tried to negotiate lower, but I think I picked 525. And the first one that came up was 172 Pilgrim Street. 3 bedroom, 1 bathroom, 1 car space. Unmatched in terms of convenience. Astute buyers seeking to renovate. So renovate, one of these value add strategies to snap back to median, will be excited by this double fronted Edwardian home. Median house price for the area is how much? $617,000. This one's for sale at, I figured it's worth a look. Next thing I did, where is this property on the map? It's here. Where's the train station? All right, so you'd have to go over to Middle Footscray in this case. But looking at the scale, it's 100, 200, 300, 400. It's about 1 kilometre away, slightly less. Now, I don't know if Middle Footscray is a particularly safe railway station. You might want to only be walking to it during the daylight hours. But I'm trying to get you to see how to use some pretty basic tools to spot better properties rather than the sort of well-marketed ones. You're looking for the under-marketed, not the over-marketed. So that's property number 1. Property number 2 at 129 Albert Street in Seddon. So this one was for sale at how much? And the median house price for the area was? This one's for sale at, okay, it's for auction, so they might be underquoting, but 450 to 475. Hang on, hold the fort. Median house price for the area, 617,000. Pick this up for 450. What's wrong with this? That's what you have to ask yourself. There must be something wrong with this one. Within 400-metre radius, you have a shopping strip, ... One for the live-in renovators, double front period residence of 6 principal rooms. Immediately speaks to me of maybe converting another one of these living spaces into another bedroom, turning it from 3 to 4 bedrooms. Veranda entry to 3-bedroom accommodation off ... All right, where is it on the map? Well, this one's really lucky because the train station is right out the back. All right, so there's the railway line. The station's only literally maybe 300 metres down the road. But the problem with this one is you must like trains because they're going to be coming by pretty regularly. That explains why the price is low. So I would have reservations about this one, because when you buy a property, as I'll teach you tonight, you need to buy it with the next person who's going to buy it off you in mind. So would you like to live in a home with the railway line just over the back fence? No, and so your chances of reselling it at a higher price are also limited by the inherent weakness of this property. All right, application. I want you to write down the nearest railway station to where you live. All right, write it down. Participate. And then I want you to find out the median house price for that suburb. Ring up a real estate agent, go online, try and find out what the median house price is for that suburb. And your job within the next 24 hours, how long? Look at your watches. You've got until 8 p.m. tomorrow night to find a house or unit in that suburb at 85% or less of the median house or unit price for that area. Who's up for the challenge? Get you out there thinking. All right, let me show you Steve's deal. So I was out. All right, if I tell you this, do you promise none of you will steal it from under my nose? Can I trust you? Put your hands up if I can't trust you. All right, I'm just going to be transparent because I believe there's enough deals out there for everyone. So I'm going to come clean on the whole thing. I live in a suburb called Canterbury. Does anyone know where that is? All right, so I live not far from Mailing Road. And I live in a road called Highfield Road. And this house is also in Highfield Road. It's about 10 doors up the road from where I live. All right? And this house is a 1910 house. And at the back, you can just see it poking its head up. There is a 1980s extension plonked on the back. It's a very ugly house from the street in an area which is full of pretty houses. It's lost its appeal. It's not a necessarily good photo, this one, but I've zoomed in on Google Maps to show you Highfield Road. And here's the house. And you can sort of see the extension that's been plonked on the top here. This is the garage and that's the backyard. If we go to the brochure, we see the residence. So Highfield Road's here, the residence, the extension, the garage. Looking at that, what would we do? Okay, we can't knock it down because it's in a heritage overlay. They won't let you knock the house down. Yep. I would lose the extension and bring the house back to here, where it was originally, along here. And then I would put the carport, which is there, out here at the back. Create a crossover or driveway here. Then I would subdivide and have a second block of land out the back. No easements, right of way at the back here. So no worries about overlooking next door or anything. This is the old night lane there. Lose the laundry, see you later. Lose the extension. Now, that's fine, but we've got a problem. We've got the old house. Now, to get a premium price in this area, what is this house missing looking on the floor plan? All right. Let me move sideways for a second. Who do you think would buy this house if I was to lose the extension on the back and lose the upstairs rumpus room and have a smaller, if any, yard out the back there? Retirees. And Canterbury is a suburb that is traditionally full of retirees that want to stay there but don't want the big house that they've had for 20 or 30 years. So it works because it's single level, no stairs, flat block of land. So my target market to sell would be to a retiree, a downsizer. And how many bedrooms do I need to make sure I preserve? So why do I need 3 bedrooms? One for them, one for the grandkids, and one for the stuff. All right, because they're going from a bigger house to a smaller house, so they're going to need a stuff room. Double up as a study. Now, this house has 3 bedrooms, but it doesn't have an ensuite. So what do I need to create? An ensuite. What would be the most logical thing to do to create an ensuite here? Remove this bedroom and turn that into a large master and a ensuite. But now I lose a bedroom, so how do I get a bedroom back? Turn the lounge room back into the same size as this bedroom and open up the dining area and the meals area. So it becomes quite a compact house. All right, I'll come back to this slide in a second. I'll show you the numbers first. The rough numbers, purchase price. I put in an offer of $1 million. They wanted 1.4 at auction. Didn't sell at auction, has been sitting there ever since. Steve comes along, says to the agent, what's going to buy this house? I normally wouldn't be looking to buy in the $1 million single house market. Upside, downside. But I came along and thought, oh, okay, we can do something here. So I put in an offer of $1 million and I was going to be negotiable to 1,050. Closing costs, paying 1,050 would be 65. Reno costs 250. Holding costs 50. Means my total cost is 1,415. So big dollars. 1,415 minus selling the front for 1.2. It's about median house price for Canterbury, slightly under. Sale cost of 24 grand means I'm owed, the block out the back owes me 239 grand. Let's say I sold it to a developer with a permit for 695, which would be giving it away. But there needs to be, I just want to get in and get out and make my profit, right? At 695, land owes me 239, GST 50 on the margin scheme, sales cost of 20 means my estimated profit's 386. 436 if you take the $1 million price if they had have accepted it. So I thought, if you were walking along the street and you saw $386,000, who'd bend over to pick it up? So I'm walking back from my daughter's high school fair on Saturday and I'm by myself. I've left the kids and my wife there at the fair for a little bit longer. And the agent's putting the open for inspection flag out the front. And I figure, hey, it's a nice day. I've got nothing else to do. I'll go and chat with the agent for a while. So I went in there and I looked down and basically no one's come to look at the house in the last couple of months. So I say to the agent, what's going to buy it? He says, I don't know. I said, give me an idea. He says, I can't. I said, what do you mean you can't? He goes, the vendors won't tell me how much they want. I said, this is ridiculous. How are you going to sell something you don't know what the price is? He goes, tell me about it. So what would you pay for it? And I'd previously, when I went through the house, did the sums and said, look, I'd be around the 1.2 mark. So he remembered me. He said, would you still pay 1.2? And I said, no, market's gone down since then. He goes, what would you pay now? I said, I don't know. Remember, in negotiation, whoever says the first figure loses. So you try and play this game where you don't say the first figure. No, he didn't know who I was. I was in my tracky pants, I think, so... Probably wanted to see some ID walking into a house in Canterbury in tracky pants. But anyway, I said, well, let's do some really rough numbers. I reckon I'd be around the $1 million mark. He goes, I don't think you'll buy it. And then he rings me up later that afternoon. He says, look, I've spoken to the vendors. You might be in with some luck. Put in an offer. And so I went to the trouble of putting in an offer. I'm there at the Virgin Lounge in Sydney trying to print off an offer and But when we put in offers and when we buy real estate, we weigh up the upside of being right versus the downside of being... Now, the downside of being wrong with this is what? If I can't subdivide it, then I'm left with a house. So my downside of being wrong is that I can't subdivide and so I can't make this profit I expect to make. I'm stuck with this as a potential rental, which is a hopeless return, or I'm going to try and do it as a reno project, but I'm buying so much for it, I might have to wait for the next market cycle in order for it to pick up, and all of a sudden it's starting to look a bit dodgy. So how do I cover myself for the risk? Clauses. So I went to my solicitor and I said, I need clauses that are going to help me to get out if I can't do what I want to do. He said, what do you want to do? I said, look, first of all, I'm working on fuzzy things here. So I need a broad clause and then I need specific clauses to get what I want. So let's go through the clauses. Clause number 1, the vendor agrees the purchaser may make any due diligence inquiries regarding all aspects of the property within 30 days of the date of this contract. How long have I got? 30 days. And then, if the purchaser is not satisfied after making the inquiries in one above, the purchaser may rescind the contract and the vendor shall refund the deposit paid by the purchaser. So I've got a 30-day due diligence period to go and do all my homework, and if I decide I don't want to go ahead, you'd never sign the contract as a vendor. Lucky you're not the one who's trying to sell it. All right, it's giving me 30 days to find out what's going on. Point number 3, the vendor agrees that the purchaser may apply for building permits under the Building Act and planning permits under the Planning and Environment Act to undertake work on the dwelling on the property. So it gives me the freedom to go and get the permits, even though I'm not the owner. Point number 4, the vendor agrees to do all things necessary and sign such documents to allow the purchaser to lodge any building application and planning application with the council. So I'm not the owner, so I need their consent to be able to do this. Point number 5, the vendor agrees that the purchaser may apply for a planning permit to subdivide the property into 2 lots, and the vendor agrees to do all things necessary and sign such documents to allow the purchaser to lodge the application with council. And point number 6, prior to settlement, the vendor agrees to give the purchaser and the purchaser's agents or contractors access to the property, including the dwelling, to enable plans for renovations to be prepared and estimates for work to be carried out. The vendor shall not unreasonably withhold such access. It's a pretty comprehensive set of subject to conditions, isn't it? Well, maybe, but they've had no offers. If they want to sell, then this is, I'm a buyer. Okay, the question here is, wouldn't it take longer than 30 days to find out? And the answer is probably, but then I'm accepting the risk. So I've got 30 days to do as much as I can to work out whether I want to take the risk or not. 7 days wouldn't be enough time, particularly with Easter. 30 days is probably going to give me enough time. All right, so let's move forward. So I was pretty excited. I thought, look, $1 million isn't going to buy it. Maybe a bit more will. And then I got an email today at 1:22 p.m. Read it with me. Dear Steve, finally heard back from they think the offer is and disagree entirely with the deletions of the clauses. Because I went through the contract as well and took out some of their special clauses, according to my lawyer, in order to do this. All right? So, who thinks the door got slammed in my face? All right, so, did I walk away? Yes or no? What did I do? There's 3 things you can do. You can walk away, you can buy it for whatever they want, or you can renegotiate. Which one do you think I did? All right, so, in the words of my first business partner, Dave Bradley, that's only a suggestion. All right, Thursday, March 29 at 1:59 p.m. Dale, letter I received as discussed from my lawyer telling me to delete the clauses. Blame the lawyer, don't take acceptance. The only way I would be able to go to 1.1 mil is if I could make it subject to getting the planning permit for the subdivision of the back. I had offered less and was willing to take on the risk. If I didn't have to worry about the risk, then I'd be happy to pay a bit more. So last time I did the market update, I said be flexible on price, flexible on terms, but not flexible on both. And here's a way that this is playing out in real life. All right, so I'd be happy to pay even more than 1.1 if they wanted to give me certainty that I could get the back subdivided. It means I make less profit, but it means I have less. Exactly. Now, I don't know if any of you have ever met Stu Silver. Some of you I know have been over to the States and met the great man. A couple of years ago, reading his book, in his book he said this quote, "If you're not making offers, you're not..." Let's all say it together. If you're not making offers, you're not... making money. Normally I wouldn't have made an offer on this. And the chances are it's not going to be accepted. I don't want to waste my time, but I wanted to show you tonight a deal that was in my own backyard. I'm so focused on walking the kids to and from school. I walk past this property twice a day. I didn't really give it a second thought, but there was the gorilla. 5 doors up or 7 doors up or 10 doors up, however many doors up it is from my house, there was a gorilla. And I was too busy walking the kids to and from school each day to see it. What gorillas are up the road from you that you are too busy not looking at? Part 4, the art of selling property. When it comes to selling property, there's 2 schools of thought. There are those people who say you should never sell, and there are those people who say you should sell. There are more people in the camp of saying don't sell than there are people who say do sell. Now, the people who say don't sell for 4 main reasons. The first one is if you don't sell, you don't pay any tax. Why would you pay tax if you don't have to? The second part is you can still access some of that capital appreciation by refinancing it, maybe up to 80% of it, subject to what you can qualify. So if you can get up to 80% of your equity anyway, you'd be mad to sell. The third reason they say is that if you sell and you plan to rebuy, you're going to have to pay stamp duty. That might be 30 or 40 or 50 grand. What's the point of paying 30 or 40, 50 grand if you don't have to? And lastly, once that property's sold, if it keeps going up in value, then I've missed out on that gain. Are those 4 reasons valid? Yes or no? Yes, totally. What are the reasons for selling then? Well, it releases and it realises a profit. In the global financial crisis, lots of people had paper profits that went down. We saw that on that article before, that most people's net wealth was down, what was it? 11, 17%, something like that, off its peak in 2007. So when we sell, we actually bank the profit, and you bank dollars, not percentages, as Marty Ailes says. Second reason is that you lower your credit risk because you repay the debt. Third reason is you have increased buying power because you have more cash. And the fourth reason is you have increased borrowing power via your tax return. When you sell, you make a capital gain. You've got to put that on your income tax return. You've got to pay tax on it. When you go for a loan, the lender asks to see your income tax return. And if you've made more capital gain, if you've got a capital gain on your tax return, have you made more or less income? More. So if you've got more income, do you think you'll be able to borrow more or less? More. Now, if you had a choice, the truth of the matter is you wouldn't sell. But the way real estate works is that you can only ever own 1, 2, maybe 3 properties before you max out. And you can't go to any more. And if owning 1, 2 or 3 properties isn't going to help you achieve your goal, you're going to have to do what? You're going to have to sell. It's a cost of building your property empire. Now, but people say to me, Steve, I don't want to sell, but I want to buy more property. But I don't want to pay the tax, but I want to buy more property. And what does that sound like? Monkeys. Here's a revelation for you. Properties are investments that you hold for a return. They are not eggs that you sit on and hatch. Properties are, they're investments, they're not eggs. And you hold the investment for a return. Remember that. So what is the time or the trigger to say sell? The time to sell is when you can get a better return in less time with less risk. Lazy money. Lazy money is caused when your property's value appreciates faster than your property's rent, causing your overall yield to fall. All right, this is a bit late in the night to cover this, but we'll try and persevere on. When your property's value is going up faster than the rent, the yield falls. Let's look at it. Let's say you buy a property in year 0 today for $200,000. The rent's $20,000. $20,000 divided by 200,000 gives you a return of 10%. The rent goes up by 3% from 20 to 20,600. Cost is still 200. Return goes to 10.3. Another 600 in year 2 and another 600 in year 3 means 21,800 divided by 200,000 gives you a 10.9% return. Are you happy? Because your return's going up. Of course you're happy. You're thinking, wow, this is great. But cost is not relevant. Cost is only relevant to accountants. If you think cost is relevant, you're living in the past. We want to live in the present. And if we took this example and we built in $10,000 a year of capital appreciation, then our rent is going up, but the value of our property is going up by more, so our overall return, income-wise, is going down. Even think of it this way. If I got $10,000 as a capital appreciation year one, my return is how much? 5%. But if I got 10% on 210,000, it's less than 5%, isn't it? So even though I'm getting $10,000 in appreciation every year, the actual percentage appreciation on value is going down. Revelation. When you think about your properties that you own, do you think about them in terms of what you paid for them or what they're worth now? Don't lie to me. You think of them in terms of cost because that's your frame of reference. You know what you paid for it. You don't necessarily know what it's worth now. You say, I bought this 5 years ago for 200. It's now worth 600. What an awesome investment. Cost isn't relevant. Doesn't matter what you bought it for. It matters for capital gains tax purposes and nothing else. You are an investor who holds an asset for if that return's going down, why would you keep holding this asset? Rena, your mum's return is abysmal because it's made a whole lot of value, but relative to what it is now, it's quite low. So, I was thinking of you when I put these slides together. Okay, righto. So we've got 3 types of losses you can make in real estate. I think you'll get 2 of the 3. What's the first one? A capital loss. What happens if we make a capital loss? Price goes down. What's the second type of loss we can make? No, not depreciation. Come on, it's not rocket science. Income loss. How do we make an income loss? Yes, we make an income loss when our expenses are greater than our income. And what's the third type of loss we could make? Who said that? Smart cookie. Opportunity cost. Opportunity cost is the value of the next best benefit foregone. If you don't know what your opportunity cost is in terms of what other properties you could be investing in, the risk-free rate is the rate that you could get on a term deposit. If you sold your property and just put the money in the bank, you might, in the current market, be able to get 5%. So if your property is not returning 5% or better, why would you own it and accept the risk when you could just put the money in the bank? Even if you're not making a capital loss or an income loss, you might be losing a ton of money by having a whole lot of lazy money that is doing nothing when it could be earning a good return, but it's earning a 0% return. Coming back to this example here, how much extra income is being made by the appreciation in value? I'm going to jump up and down because you're looking tired. All right. Again, none. There's no income. All the income attaches to the original purchase price. Yeah, it's rent. That's what it is. But all of this rent relates to what you paid. None of it relates to the increase in the appreciation. So your appreciation is great. It's returning growth, but it's not returning any extra income. You're looking at me like stunned fish. Sooner or later, you're going to be able to do better by cashing out of that lower yielding investment and redeploying your money into higher yielding investments. But the first thing you have to change is the way you look at your real estate. Instead of looking at it from a cost point of view, You've got to look at it from a current market point of view, and then you've got to say, how much money am I missing out on because I don't want to pay tax? Wow, hang on. That's actually a really important point. Let me rewind. How much money are you missing out on? Sounds like because I don't want to pay any, holding on to the peanuts. I don't want to pay tax. I wish you didn't have to pay tax, but if you make money, you pay tax. They've figured it out, right? The government's smart. They've had 80 years to work on the tax system. You're not going to outsmart them. And would you rather make money or lose money? Obviously. People say, Steve-O, how did you buy all those houses? 130 properties in 3.5 years. I can't even buy 2. How did you buy 130? And the answer is multiplication by division. Cashing out of lower yielding properties and reinvesting into higher yielding properties. Starting off in Ballarat, doing vendor finance, buying $40,000 houses, selling them on vendor finance for $65,000, being cashed out by the buyers, taking that extra money that we made and then reinvesting it in the Latrobe Valley. And then when the Latrobe Valley went up, into Tassie, and when Tassie went up, into New Zealand. When New Zealand went up, we think, damn, there's no more cheap properties. What are we going to do? So we moved into, instead of generic, we moved into manufactured. And then the mother of all opportunities happened, which was the US. And so I took my money out of Australia and ploughed it over to the US because I'm an investor who is wanting a return, and I could get a better return by doing that than staying here. And now that properties in the US have started to go up, guess what I'm going to start doing? Selling. Can I tell you a really funny story? Anecdotal. I don't have time, but it's a funny story anyway. One of the properties that I bought in the US is an old house that got converted into offices. And for those of you who've been to the US, it's Fowler Street. Yep, so you guys picture Fowler Street. Oh, can't help myself. I love this story. In the property apprenticeship, I run a weekly webinar. And so the last week's webinar was on commercial property. And I talked about this property. So this is Fowler Street, right? So it's a house that's been converted into an office right on the edge of the legal precinct of Fort Myers, downtown Fort Myers. It was worth, in 2010 property taxes, $189,000, ended up buying it for $88,000. All right, so managed to negotiate a significant discount. Between when we agreed to buy it and when we came to close on it, something happened. Can anyone see a problem with that picture? Look carefully. If you wanted to get out of the top door, it might be a heck of a way down. The county came and demolished the fire exit or the emergency stairs because they weren't up to code. And we said, hello. And it was a bank foreclosure. So through the realtor, we gave the realtor an option. Either we'll take $8,000 off the purchase price and we'll build back the stairs, or we'll pay $88,000 and you build back the stairs. Guess what they chose to do? Okay, so the upside of being right versus the downside of being wrong. Their downside of being wrong is how much? $8,000. Or their upside of being right. Here's what happened. They decided that they wanted the $88,000. And they had to rebuild that. That's what it looked like. That's what it looks like now. And then a funny thing happened. The county came to do an inspection. They said, whoa, the mandatory disabled car park is now on the wrong angle for the ramp. You also need to redo the car park. Total cost, $30,000. All right, so that's the shock part of this story. The good part is that we've got a tenant for this property now. It's only on a short-term lease till the end of November. But I want you to think big. Who do you think the tenant is? Think big. the Democratic Party of Florida, Obama's re-election campaign, have come and hired the building till the end of November. Now, it's a bit of a stretch to say it, but I've got Obama as a tenant. I love that story. And when you factor it into what happened, it's just amazing. $1,500 a month till the end of November on a property that ended up costing us $88, $15 to reno it, because we had to do some work inside. Total purchase price of $103, rent $1,500 per month, purchase price $103, cash on cash return 17.5%. Yeah, they had to pay to fix up the car park as well. Didn't have to pay that. That reno cost was just inside, and most of that was air conditioning. All right, so a couple of sales secrets for you when it comes to selling. Number one, buy with the person who'll be buying the property off you in mind. All too often, people believe it is the bricks and sticks that make up the property that causes it to go up in value. It doesn't. People are the ones with checkbooks. So if you're buying it as a rental, think about who's going to rent the property, and your job is to make it more appealing or convenient for them. If you're buying it to sell it to someone else to make capital growth, think about the person who's going to buy it off you and make it more appealing to them. It's not the property that's going to make itself more valuable. It can't. It's not alive. It's dead. It's someone buying it or renting it off you. So your job is that while you own the property, you need to make it more appealing and convenient. So don't worry about the property. Take your mindset out of the property and put it in the mindset of the person who is going to be in or buying it off you, and then help them make better use or more convenience of that property. If you can do that, you'll be streets ahead of the average property investor. Second sales secret. When selling, feature the person, not the product. Don't say 1,000 square metres, say ideal subdivision if you're selling to an investor. Find out what the person wants, who you think is going to buy it, and link it to what your property offers. I'm going to spend a bit of time on this third point. Is anyone here a real estate agent? I'm yet to have a real estate agent own up to being a real estate agent, as I've asked this question around the country. All right. Real estate agents have a massive conflict of interest. Let's say that you're selling a property for $500,000. And let's say the agent's getting a 3% commission. So the agent's going to make $15,000 by selling that property. And you want as much as possible. So there are two buyers who are interested in this property, and you want to get them up to $550,000. But the commission on $550,000 is how much? $16,500. So to get an extra $50,000 means the agent makes how much more commission? $1,500. Versus if they took this person, this second person, and tried to sell them another property that they had listed at $500,000, how much commission would they make? Another $15,000. So what would you do if you were a real estate agent? You would maybe try and do the extra 50 grand, but ultimately you'd be more interested in trying to sell them the other property. Conflict of interest. Not saying real estate agents are dodgy, far from it, but identifying a conflict of interest that exists. Hand in hand with the conflict of interest is real estate agents trying to use your advertising dollar to trawl, bring people into their agency, because great if they sell your property. If they don't, they might be able to sell another property. And so you don't want that. You don't want to be paying your advertising dollars to sell another property you don't make any money out of. So what you need to do, as sales secret number 3, is to look at all the people at the top of the sales funnel here. And normally agents want to pour a whole lot of people in at the top. Fewer will read the ads, fewer will call, fewer will inspect, fewer will make an offer, and one monkey might drop off down the bottom. You want to try and think about this person here and put more of this person here up here. So you don't want just anyone, you want someone. When it comes time to selling real estate, most people don't know what to do. They put it in the hands of the agent. The agent presses the default button, puts out a generic ad, brings in a whole lot of people, and you get frustrated that you don't get the price you want. Well, the system isn't designed to work for you. You need to have a smarter approach towards the system. When it comes to auctions, I don't think they're a good idea. I'm about to sell my first property at auction, or at least try to, and it's a property in New Zealand, which I think is a bad idea to sell at auction, but we're trying to force a result because we've had it for sale for a while and it's not selling. Generally speaking, I say don't sell at auction because that's another agent tool to try and bring people into their agency. If the market is red hot and you want to speculate, then go for it. Otherwise, simply sell via private treaty for sale. Name your price, be smart about your marketing campaign, don't cross your fingers and hope a couple of wood ducks turn up on the day and outbid each other. Be more strategic than speculative. So the conclusion, knowing when to sell is just as important as knowing when to buy. Focus on the person, not the property, and beware conflicts of interest. Now, this doesn't make much sense to you at all until you come to sell, in which case this will mean a whole lot. People ask me, Steve, why do you do this? You know, aren't you supposed to be financially independent? Why do you keep doing this? I'm going to tell you the answer. The answer is I like doing it. All my mates work and my kids are at school, so I'd be bored. But I only do it as much as I want to do it. And I do it because real estate has had a profound impact on my life. And I think the way that most people invest in real estate doesn't work. And so I'm passionate about educating people. And I get a real buzz out of when I meet people and they say, I read your book, or I came to a seminar, or I'm doing some training that you're doing and you've helped me make money. I get chuffed when people give me that feedback. I get really happy. There's one problem with what I do that I constantly struggle with. The wealth creation industry is a sewer. And even though I try to think that I don't smell like the sewer, the truth of the matter is the wealth creation industry is a sewer. It's full of people who sell things that sound good, but people can't use to make money out of. And maybe you've even had a go at some of the things in the past to have a go at doing that. So I went away and I thought, wow, what can I do here to try and stand out in the right way? And so what I did is I went away to create a training course that takes 66 weeks to complete. And the idea behind the training course was to map it to nationally recognised competencies. So instead of being something you just do, there's something that you work towards in the course, which in this case is a certificate 4 in business. And then I put a marketing name around it. I called it a property apprenticeship. I get really frustrated when people buy hundreds of thousands of dollars worth of real estate with no training. It really frustrates me. So if you would like to be trained by me over a 66-week period and to really invest into your real estate, then there are some brochures that you can take home to learn more about it tonight. They look like this. Don't leave without grabbing one. All right? Guys who are doing the property apprenticeship, can I get you to stand up for one sec? So you can see in the room there are some people who are doing it at the moment. I just want to help. If you don't want my help, that's fine. I don't want to try and ram it down your throat. If you want to spend 66 weeks being trained by me to do a course which is mapped to nationally recognised competencies, and you want to get those skills that you need to be a successful investor, then jump on board. How much is it? Look, it's $2,995. Once I've been asked to do some seminars in about 2 weeks, and from 2 weeks' time from now, the price will go up to $3,995. All right. So it's not going up tonight, but in about 2 weeks when I go to do these seminars for Dr. John DiMartini, is that right? I'll be selling the course at those events for $3,995. So you've got a chance to get in while it's a little bit less. The other thing about joining up as a property apprenticeship is that you get 2 free tickets to come to our annual property investing conference. Part 5, the looming great property boom. Every week in Victoria, if we take net migration and add in natural increase from 20 years ago, there are 1,531 new people who need somewhere to live. Now, they're not all individuals though, are they? No, because some of them are kids, some of them are families, etc., etc. If we made an assumption that the families balanced out the singles and we just divided that by 2 people living in each house, we need 766 houses a week, or 3,317 houses per month, or 39,804 houses per year to meet housing demand. Or one of my assumptions in my statistics is wrong and this is wrong. But I think this is a pretty fair statistic and you'll see why in a second. If we need 3,317 houses, at the moment we are only building 2,672 houses a month. And that's the average number of housing approvals in the private sector over the last 12 months. Last month, we only did 1,700 houses. If we, it says New South Wales there, it should say Vic. If we look at Victoria, that's 39,804 houses per year, and we are building 32,068 houses per year. Late breaking news! 29th of March, Australia's annual population growth rate remains steady at 1.4% for the year ending September. According to the ABS, this was the 4th consecutive quarter that the annual population growth rate was 1.4%. Western Australia continues to have the fastest growing population in the country. Everyone gasp. So piecing together what else we've talked about tonight, where might we be looking for dumb growth? This was followed by the ACT, Queensland, Victoria, New South Wales, South Australia and Tassie. Over the same period, Australia's population increased by 319,000 people. Net overseas migration continued to decline, but only slightly. Based on preliminary figures, there's 294,000 births registered in the year, etc., etc. Each year, the government puts out a National Housing Supply Council report, State of Supply. Table 5 in that document says by the year 2030, we will have 640,000, we will have too few houses by the tune of 640,000. There will be a housing shortage of 640,000 houses. Now, we're here. This is now. That's minus 30 years ago. This is plus 30 years from now. And we're on the continuum. If we looked at the Australian Stock Exchange top 200 of 30 years ago, how many of those companies still exist in that format today? Lots or few? Few. So if we were projecting 30 years into the future, how many of the current ASX 200 shares do we think are going to be around? It's logical to think there are going to be. So if we could choose between shares and houses, and we looked at houses that existed 30 years ago, and that same house that's going to exist in the future, do you think, with this in mind, this house will be worth more or less than it's worth now? So if you want to make a bet on something still being around in 30 years' time and worth more than it is today, I think these numbers indicate that housing is a less risky asset class to be investing in. Now, you can still make lots of money here. I just think this is a less riskier way of doing it. The obvious question is what? Where's everyone going to live? Because we have to live somewhere. Come and live in me. No, I've only got one spare bedroom. You can't all fit in there. Australia-wide, New South Wales, there's a shortfall over the last 12 months of 22,000 dwellings. Victoria, shortfall 7,000. Queensland, 10,000. South Australia, a surplus of 313. WA, a shortage of 11,025, and ACT, 1825. Didn't I say that there was an oversupply of 37,000? No, I'm saying the number of houses for sale right now is 37,000, and that's an increase over the previous year. There's still a slight housing shortfall in Victoria, and as we build less houses, because housing approvals is going off a large peak, the shortfall will get better or worse? Worse. Good. Why aren't there more houses being built? Because people can't get finance. Why are the rental yields so low? Because prices are so high relative to rent. Because home buyers are emotional people. And so investors compete with home buyers who are willing to pay more for their home, and so the yield gets dragged lower. It's the nature of the beast. All right, really quickly. God, I'm out of time again. Increase in population leads to increased rental demand, leads to increased rental yields, leads to increased investor interest because they're better returns, leads to an increased housing price. Make sense? Yeah. Now, again, we're sitting here now and we're thinking, everything else being equal, over time we're expecting house prices to go up. Does that mean there won't be peaks and troughs in the market? No, there'll be better times to buy and better times to sell. And so there might even be periods where the market really goes up and then sideways, or the market might even go up and really go down. But the long-term trend, in my opinion, will remain. And at any point in time, there'll be volatility. You just want to make sure that you don't get wiped out when the volatility goes against you. And that's investing skill. Who's learned something? All right, good. Mission accomplished. Steve-O's a happy camper. No time for questions and answers, but I'll hang it back tonight for a little while if you want to come up and talk to me. All right. One more time. You have your past, and you have your present, and you have your future. I want to talk to the people whose future won't be achieved based on their present situation. Let me say that again. If your present situation won't achieve the future that you want, I want to talk to you. But since I've gone over time tonight, if you're not in that situation, I want to wish you a happy Easter and release you to go home if you want. All right? And say thank you very much for coming along. Don't feel bad. Thank you. Round of applause. So if your present situation is good and your future's okay, no worries. If it's not, I want to leave you with the 4 things that you need to do to change your situation. All right? Take an extra 5, maybe 10 minutes. All right. At church not last Sunday, the Sunday before, the senior pastor put up this slide, which I thought was an absolute classic. And I want to read it with you. It's one of these, like success posters that were popular about 10 years ago. But this one says, incompetence. And it's bent nails, right? So someone trying to hammer in a nail. When you earnestly believe you can compensate for a lack of skill by doubling your efforts, there's no end to what you can't do. I see this all the time. People think if they work harder, doing more of what they don't know what they're doing, they'll do better. Here are the 4 things you need to do. Number 1 is you need to take a chance. It's the hardest thing to do. because there's fear of failure. All these reasons that we looked at the start of the night that are holding you where you are at the moment are the reasons why you can't move into part number one. You have to take a chance. Part number two is you have to find out new things. Guess why you have to find out new things? Because if you knew it, you'd be doing it. So there must be some knowledge gap that you've got at the moment which is not allowing you to move into the future. You must need to know some new things. Point number three is you need to find relevant applications. There's no point knowing something if you're not applying it. And point number four is you have to take action, because there's, being an academic investor won't make you rich. Yep. Now, I've come up with a new saying, and it's called a turning point. I think in our lives, there are maybe 4 or 5 turning points that happen. Major events that cause you to change direction. So I want you to take a risk with me for a second, and I want you to close your eyes for like 10 seconds. And as you close your eyes, I want you to think of a massive risk that you've taken in life. And then, are you smiling? That will, open your eyes. That will determine whether you're an optimist or a pessimist right there. If you're thinking about taking risks and you have positive association with taking risks, then you're likely to move on. If you've got negative association with taking risks, you're going to find it that much harder to move ahead, because you are conditioned to think, oh, that hurts, I'm not going to do it. I'm going to share with you 2 turning points in my life. The first one was when I quit my job working for ICI, or Orica as it is now known, and moved to Mackay to woo my now wife. That was a turning point, right? But I had to take a chance, didn't I? I had to find out new things. I didn't know what was going to happen moving to Mackay. I had to find a relevant application. I had to go there and I had to take action. But that put my life on a different learning outcome. A second turning point was me being where you are at an event run by a guy called Robert Kiyosaki, an information session in 1999. And I went along, some friends invited me to the information night. I don't know how much it cost to go along. And at the end of the night, Kiyosaki said, I'm running a 2-day seminar the following weekend up in Sydney. There are like 5 spots left. Who wants them? And I thought, wow, I'd love to go. And if you've read my first book, you'll know the story of how I went outside, rang Dave on his mobile. He said, we don't have the money, can't go, hung up on me, rang him at home, said, do you trust me? Ended up paying $1,695 plus flying to Sydney, plus accommodation to go to a 2-day seminar. And the seminar was great, but there was one part of the seminar which was the turning point, when a real estate agent got up on stage and said, I don't know why people invest in negatively geared property, because you can buy positively geared property. And because I was an accountant, the only thing I knew how to do was negatively geared property. It was a revelation to me. And so going along from that seminar, I had to take a chance. I had to find out some new things. I had to find relevant applications and take action. Got in the car, went to Ballarat, found positively geared property, bought my first property 2 weeks later. Turning point in my life. It's hard to create internal turning points. You need an external event to give you that turning point opportunity. And although it seems a little bit cheesy, I want to try and give you a turning point opportunity. And for you guys, it should be an absolute no-brainer. When you registered, you would have been given this form. Can you pull it out for me for a second? On the 1st, 2nd and 3rd of June, which is a Friday, Saturday and Sunday, I'm running our 3-day PropertyInvesting.com conference in this building, probably in this room There are going to be some workshops. This year, it's the first time we've run a conference and I've been the sole owner of PropertyInvesting.com. So what I've done is I've rung up my friends and mentors and said, I want you at this one. Do whatever you need to do to get here. And so 3 people who are coming you've probably never heard of before. Well, one of them you might have. Have you ever heard of Zig Ziglar? All right, so I've become pretty good friends with his son, Tom. So Zig's 85, he doesn't travel anymore, but I've asked Tom to come out for conference. Paid a whopping big speaking fee and first and business class accommodation to get him out here. You don't want to miss it. Derek Gill is the guy who taught me how to make money on the internet 10 years ago. And PropertyInvesting.com is the birth child of his training. One of the biggest problems we have as property investors is the capital to go and buy more property. One of my beliefs is one of the best things you can do is create an internet site to build more income you can use to invest in real estate. So Derek's coming out to talk to you about how to do that. He sold his internet training company for tens of millions of dollars. He's a guy who knows what he's talking about. Diana Nightingale, for those of you in the property apprenticeship, the late Earl Nightingale is a big influence in my life. Earl's no longer with us, but I've asked his wife to come out and be the Saturday night very special speaker. And she's going to change your life. Diana is in her 60s, an amazing woman. Aside from those speakers, it's all about real estate. Positive cash flow, capital growth, renovating, developing, creative cash flow. I'm going to be doing a lot of speaking. Marty Ailes, my US business partner, Dean Parker about renovations, etc., accountants, lawyers, real estate agents. Look, let me cut to the chase. There are 1,200 people who can come to conference. At the moment, 1,056 of those tickets are taken by those in the property apprenticeship and iClub. So that means that I have theoretically around 200 tickets left. Not everyone will come, so 200 might become 400. I'm about to speak to 8,000 people on the back of these one-day seminars that are coming up, 2,000 in each state. I'm going to be pushing on the back of that the property apprenticeship, which gives them 2 free tickets to come to conference while there are still tickets left. I don't think I'm going to go to the database this year and say, do you want to come to conference? You guys are in Melbourne. You don't have to travel. Like the guys in Brizzy and Sydney and Perth who've signed on to come have extra cost. There is no excuse, in my opinion, for why you shouldn't be there. It's just a question of whether or not you want that turning point opportunity. You might say you're too busy, it's the wrong time, you don't know how, you're scared. The truth of the matter is most of you guys aren't going to come. And it breaks my heart that you're not going to come because you're going to miss out. I believe the ticket's going to sell whether you come or not, but I'd rather people from Melbourne turned up. So if you want to come, please fill in the form, put your name, your detail, $295 for 2 tickets. It's an outrageous bargain. Not each, $295 for 2 tickets for the total 3-day conference. Fill it in, hand it in before you go home. Don't miss out. You need to do 4 things. You need to take a chance. The downside here is $295. It's a pretty good downside. You need to find out new things. That's what this seminar is all about. You need to find relevant applications. That'll be up to you after the seminar. And you need to take action. If you can do those 4 things, I guarantee you that whether we talk about investing or relationship or anything else, you will move from your past into your present into a better future. I've got one more book that I'm going to write. It's going to be called Born to be Financially Free. And it's going to be talking about moving from your past into your present, into your future, and overcoming those things that have always been holding you back. I haven't even started writing. Don't expect it anytime soon. But it's what I'm so passionate about. And I think it's a really cool title. Can we thank the guys who helped tonight, in particular, James and Kim, and I've forgotten who else is helping, and Jace in particular, Alison, thank you very much. Good job, guys. I hope to see you at conference. I want to leave you with one more thought. That is a quote from the Bible, one of these funny Christian types. As iron sharpens iron, so one man sharpens another. Do you feel you're sharper walking out than when you walked in? All right, so we've had 2 hours to do that. Imagine what we could do in 3 days. We'd be dangerous. I hope to see you back in June. Thanks for coming. Have a happy Easter. Thank you very much.